We're just going to start off, Mustafa Abdullah. Just wait a bit. Okay. So we are just going to start off with this question, the name of which is Luploid company. Let me give you a brief background about this Luploid company. Please uh, try to understand this thing, that this is one of the past examination question which we are going to be attempting. It's an ACCA SBR past examination question. So with respect to this specific question, let's just start off. Let's just start discussing that what exactly is the examiner asking us in this question. It says Luploid company is the parent company of a group undergoing rapid expansion through acquisition. So what is happening? It's a parent company of a group which is undergoing rapid expansion through acquisition. Luploid has acquired two subsidiaries in recent year, Collison Company and Hammond Company. The current financial year end is 30th June 2008. So with respect to the Luploid company, there are few things that are available, which is that there is a company called Collison Company which they have acquired. There is a company which is called Hammond Company which they have acquired. Now, what are the requirements to this question? So you see, what happens is this is a 30-mark question, and the majority of the requirement that you would come across in this specific question, they would actually be requiring you to discuss. I repeat, the majority of the requirement that this question is going to be requiring you is going to be to discuss. So now what exactly are the different requirements? Let's try to have an understanding of this. Basically, it says draft an explanatory note, to the directors of Luploid company addressing the following. So what do you need to address? So let's try to understand what is it that we need to address. It says how the fair value of the factory site should be determined at 1st July 2004, and why the depreciated replacement cost of 17.4 is unlikely to be a reasonable estimate of fair value. So although it's a question which is on consolidation, but this question actually is requiring more about, I repeat, this question is requiring more about IFRS 13 fair value measurement. I repeat, the major requirement pertaining to this question is more pertaining to IFRS 13 fair value measurement. Now, what next is there? Second is a calculation of goodwill arising on the acquisition of Collison company, measuring the non-controlling interest using fair value, using the proportionate share of the identifiable net assets. Now, this is something that you need to try and understand, that what exactly is the examiner asking. He is actually asking you to prepare the goodwill calculation using when the non-controlling interest is actually being measured at fair value, controlling interest is being measured at proportionate share. So that means one of the goodwill that you would be calculating is the full goodwill, and the other goodwill that you would be calculating, it's actually termed as the partial goodwill. Now, let's try to have a discussion about it, that how exactly are we going to calculate the goodwill, full goodwill and the partial goodwill. We'll go through it. So there is this goodwill calculation also, which is examined in this question. Then it says discuss the calculation and allocation of Collison company's impairment loss at 30th June 2008, and why the impairment loss of Collison would differ on how NCI are measured. So it's actually the impairment loss and the goodwill. That's what the third part of the question is. It's majorly the impairment loss and the goodwill. That's what the third part of the question is. Now, next requirement to this question is that how the consideration for the acquisition of Hammond company should be measured on 1st July 7. So it's actually the consideration which is required to be measured. So you have to perform the calculation. Your answer should conclude the calculation of the consideration and a discussion of why only some of the cost of the replacement share-based payment scheme should be included within the consideration. That is something that you have to talk about. So there is another part which is talking about the consideration with respect to the acquisition of Hammond company, which is another company which is being acquired. Now, what next is there? The next situation that you need to understand is how much of an expense for share-based payment should be recognized in consolidated P&L or the Luploid. Your answer should include a brief discussion of the vesting conditions. So if you look at the questions requirement, there's a requirement to calculate goodwill. There's a requirement pertaining to IFRS 13. There's a requirement pertaining to the impairment loss allocation. There's a requirement pertaining to the consideration. There's a requirement pertaining to IFRS 2 share-based payment transaction application. That is what it is. So you've got multiple requirements which you have to deal with in this present situation and in this present scenario. So that is something that you have to deal with. Now let's just start going through this question. We know this thing that even if we don't read the whole question, I repeat, even if we don't read the whole question, we can still attempt the question. This is actually for the part, this is actually for the part C, the Hammond company. Then what happens is, this is for part B, the impairment of Collison company, and the rest of it, this is for part A. That's what you have to do. So what I would tell you people is that, I repeat, what I would tell you people is that don't read the whole question if you can actually solve the question by reading parts of it. I repeat, don't read the whole question if you can solve the question by reading parts of it. Because if you can solve the question by reading parts of it, that is going to be sufficient enough. Now, let's move a bit forward and discuss further. So let's just start discussing about it. I would want you people to take 5 minutes and read this specific part of the question, and then I'm going to start discussing. Because I start discussing, because if I start reading, then ultimately a lot of you people actually cry that you don't get to understand it. So I'm letting you people study the question first, and then I'm going to start. Okay, now let's just start. So if I read through this part of the question, it says acquisition of Collison company. What is it? The acquisition of Collison company. Now let's try to understand this. Okay, it says that Luploid company acquired 80% of the 5 million equity shares of Collison company on 1st July 2004 for a cash of $90 million. So we know this thing, that the key information over here is that what it did was it acquired this Luploid company acquired Luploid acquired Collison company. The percentage acquisition was, I repeat, the percentage acquisition was 80 million, 80%. This was 80%. And the date of acquisition was on 1st July 2000 x4. Then it says, so it acquired this company for this 80% of the 5 million equity shares for a cash of $90 million. Total shares are actually 5 million, and the consideration that you have paid is 90 million. Now, what next is there? The next information with respect to this question is, it says, Luploid, the fair value of the NCI at acquisition was 22 million, and the fair value of the identifiable net assets at acquisition was 65 million, excluding the following asset. So the key information over here is that you have got the fair value of the non-controlling interest to be 22 million. You have got the fair value of net assets excluding sum is 65 million. What other information is there? It says that Coloson purchased a factory site several years prior to the date of acquisition. Land and property prices in the area had increased significantly in the years immediately prior to 1st July 2004. Nearby sites had been acquired and converted into residential use. It is felt that should the Coloson site be converted into residential use, the factory site would have a market value of $24 million. 1 million of the costs are estimated to be required to demolish the factory and to obtain planning permission for the conversion. Coloson was not intending to convert the site at the factory at acquisition date, and had not sought the planning permission at that date. The depreciated replacement cost has been correctly calculated as 17.4 million. So the depreciated replacement cost has been correctly calculated as 17.4 million. Now let's try to have a discussion that how exactly are we gonna be calculating the goodwill for this specific company. See, what you need to do is that you need to understand what does IFRS 13 fair value measurement tells you. So in accordance with IFRS 13, I am going to guide you about few of the important things which are mentioned in IFRS 13, which is that fair value is the exit price. Remember, it's the exit price, not the entry price. So what exactly do you mean by the exit price? The exit price is the price at which the asset could be sold or the liability could be settled. So you see, I repeat, it's not the entry price, it's the exit price. What is the difference between the exit price and the entry price? The exit price is the price at which the asset could be sold, or the liability could be settled. Between market participants. So when we talk about the fair value, because you see what happens is, this is more of a IFRS 13 application to this scenario rather than the application of the consolidation. So it's more of a IFRS 13 application, that the fair value is the exit price. That is, it's the price at which the asset could be sold, or is the price at which the liability could be settled between market participants. Now, is that okay now? So fair value is the exit price. I repeat, the fair value is the exit price. It's not the entry price. What exactly do you mean by the exit price? The exit price would actually mean it's the price at which the asset could be sold, or it's the price at which the liability could be settled. That is what it is. Now, let's move a bit forward and let's discuss further. Furthermore, in order to estimate fair value, in order to estimate fair value, in order to estimate the fair value, the value which provides, which refers to the highest and the best use should be considered. So in this present situation, although the factory site is not meant for the residential purposes, but rather for the industrial purposes, but considering that other sites in the area are getting the planning, are getting the permission to be converted into the, but considering that other sites in the area are getting the permission to be converted into the, are getting the permission to be converted into the residential properties, therefore it is highly likely that Luploid would also get the permission. The fair value as per IFRS 13 are not entity specific, but rather they are market specific. Now, what exactly do you mean by this? That is, irrespective of the intention that the entity has, it's the market prevalent value that will be considered. So based on the above, the fair value of the factory building should be on the assumption that it will be converted into residential property, and hence it will be 24 less 1 million is equivalent to $23 million. Kindly confirm if you people get it, because it's a majorly the commentary on IFRS 13. I repeat, it's majorly a commentary on IFRS 13, but that's what the examiner was asking you to do. I repeat, that's what the examiner was asking you to do. What was he asking? He was asking how the fair value of the factory site should be determined at 1st July and why the depreciated replacement cost is unlikely to be reasonable estimate. I'm going to talk about this line also, but this is what it has to be. The depreciated replacement cost is unreasonable because IFRS 13 mentions that fair value measurement should follow the following hierarchy, that is level 1 inputs, level 2 inputs, level 3 inputs. Observable data exists, less observable data exists, no observable data exists. Considering the availability of the fair value of similar type of properties in the area, the level 2 inputs exist and hence the entity is not required to apply level 3 inputs and the depreciated replacement cost will fall under such inputs. So that is what you have to do. I repeat, this is what you have to do. Kindly check in case if you do get it or not. Well, you have to assume that if anyone who's going to buy this property from you, he's going to convert this property for the residential purposes. And for the residential purposes, that means for that person, the property is going to be worth 24 less 1 million. So 23 million is what the property is going to be worth for that person. Okay, now please check if every one of you is okay with it. Let me know if you all are okay with it. Okay. Okay, let me explain to you level 1, level 2, level 3 inputs in short. Take an example. Take an example of a stock listed company. I repeat, take an example of a stock listed company. So if assume that there is a listed company, the share price on a stock exchange is level 1 input of fair value. Similarly, a similar type of private company. So what happens is that the fair value of companies shares will be based on similar type listed company. So this is level 2. You see, there is a company which is listed on the stock exchange. The fair value of that company is being measured using the level 1 inputs. There is a company which is not listed. It's a private company, but there is a similar type of listed company. So you are measuring the value of that private company using that listed company's value. So then that is actually going to be so similar type of, like you see, you have got a private company. If you wish to calculate the value of the private company, So you have got a similar type of a listed company available. You can use that listed company's P ratio and calculate the value of private company. And when we talk about a level 3 input, assume that there is a company, no similar type of company exists on a stock exchange. So what happens is that, and no other available indications of fair value. So you would rather calculate the value using the cash flows or something like that. So that is considered to be the level 3 inputs. Do you get it now? Hamza Abdul Jabbar, you get it now? Okay, Wahib, what happens is that the depreciated historical cost is not a level 2 input, it's a level 3 input. Okay, Edwin Murphy, we are assuming that it is going to be legally permissible, because if others are getting the permission, why would you not get the permission? Okay, let me know if I can move forward, please. Yeah, please, all of you, let me know if I can move forward. Okay, what does entity specific mean? You see, what happens is, for example, if I would have told you that the Collison company wants to use this factory for the factory purposes, it does not want to use it for the residential purposes. So I will use the value which is for the factory. So that is, I am considering the entity specific circumstances. I am not considering the market specific circumstances. Think about it. That if you sell this building to anybody in the market, what would that person do? That person would say that I can buy a building for the purposes of factory for 17 million in the market. I will buy for 17 million. If I buy this building for 17 million right now, I can convert it in for the residential purposes by spending 1 million, and I can send it for 24 million. So I would rather do it. So what would the market do with this property? The market would buy it, convert it for residential purpose, and use it for residential purpose. That's what the market would do. Do you get it now? Okay, now. Well, it's a full answer, Amna. I cannot scroll up anything. There's nothing left. It's the full answer that you can see. Okay, the last statement, Mustafa, that I told you is that you see what happens is that uh, the depreciated replacement cost is not the appropriate method. The depreciated replacement cost is not the appropriate method. Why is it not the appropriate method? The reason being that you don't, I mean, let me repeat, the depreciated replacement cost is not the appropriate method because you wish to use, I mean, anybody who's gonna buy it would use this property for the purposes of residential. Why? Because they're gonna get good value for the residential purposes. Okay, let's move a bit forward and discuss further. The next aspect of this is that we need to go about with the next aspect of this question, which says calculation of the goodwill arising on the acquisition of Collison company, measuring the non-controlling interest at fair value and the proportion of net assets method. So let's just try to see few of the things because we got to read this area also before we can calculate the goodwill. It says that no, we don't need this. We can do it on the basis of this. Now let's try to understand that what is going to be the value of the goodwill. So when you are going to be calculating the goodwill, try to understand this. If I talk about this A part 2, computation of goodwill, the computation of goodwill. How would you be computing the goodwill? So the method of calculating the goodwill is cost. Then there is this non-controlling interest. And then there is this fair value of net assets. So how do you calculate it? You say consideration, you say non-controlling interest at acquisition, and then what happens is there is going to be a goodwill calculation. Now try to understand this. Basically, I can say it's a fair value, NCI at fair value. The second one of them is NCI at proportionate share. Sorry, the NCI at proportionate share. So you've got NCI at fair value. You've got NCI at fair value. You've got NCI at proportionate share. That is what you have got. Now, let's talk about it. The cost of acquisition, as we were being told in the question, is 90 million. And the fair value of acquisition is 90 million. The fair value is 22 million. The net assets, which are going to be deducted, we were being told in the question that the net assets are what? Net assets at acquisition date are 65. The net assets are 65. So we're going to say 65 plus the value of this factory building was excluded. So the value of the factory building is turning out to be 23 as per the calculation that we do. So resultingly, this is going to be 80 million. So if this is going to be 80 million, the goodwill is going to turn out to be, the goodwill would turn out to be 24 million. The goodwill will turn out to be 24 million. Similarly, if I copy the same here, so what is going to happen now is that the only aspect that we are going to remove is this 22, which is the value of the NCI. Why? Because when we calculate the proportion of net assets method, we do it this way. We say fair value of net assets multiply by percentage of NCI. So hence this is going to be what? This is going to be 88 multiply by 20%, which belongs to NCI. A lot of you people would ask, where did you get this 20%? So I got this 20% from here because we acquired 80%. What did we acquire? We acquired 80%. So resultingly, what's actually going to happen is you will have this as 18 million, and hence resultingly this is how it is going to be. I need to do one thing, which is that I just need to check that if there is no decimal aspects. Okay, now there was this decimal aspect also involved. So you've got the goodwill calculated, and the goodwill turns out to be what? The goodwill turns out to be 24 and 19.6 under these two situations. Do you get it? Yeah, is everyone okay with this? Okay, where did I get this 88? Michael Akoto, I got this 88 like this. I had 65 at the fair value of net assets as given in the question. Then there was this 23. Then there was this 23, and this 23 belonged to what? The 23 belonged to the building. I've opened the fair value of net asset at Emola. Please check it. Okay, now let's move a bit forward. The next aspect of this is that we have calculated the goodwill under both the situations when using the fair value, when using the proportion of net assets method. So you see, I adopted this strategy of only reading the part of the question. I did not go through the whole of the question. I only went through part of the question. Why? Because if I would have gone through the whole of the question, then this is also going to be uh, so we only read through that part of the question which was relevant. Now let's move on to the next part, which is discuss the calculation and allocation of Collison's impairment loss at 30th June 8 and why the impairment loss of Collison would differ depending on how NCI are measured. Your answer should include a calculation and explanation of how impairments would impact upon consolidated financial statement of Luploid company. So kindly go through this part B. Then we are going to start discussing. Okay, now, so it says Collison incurred losses during the year ended 30th June 2008 and an impairment review was performed. The recoverable amount of Collison's assets was estimated to be $100 million. So what happened was Collison incurred a losses during the year ended so and so, so and so, and an impairment review was performed. Included in this assessment was the only building owned by Collison which had been damaged in a storm and impaired to the extent of $4 million. So there was a building which was damaged to the extent of $4 million. Now what next is there? The carrying amount of the Net assets of Coloson company at 30th June, including fair value adjustments on acquisition, but excluding the goodwill, are as follows. The land and buildings, the plant and machinery, intangibles other than goodwill, the current assets, which are also measured at recoverable amount. It says none of the assets of Coloson, including goodwill, have been impaired previously. Coloson does not have a policy of revaluing its assets. Now, let's try to have an understanding of it. Basically, when we talk about the calculation of goodwill, impairment, sorry, when we talk about the computation of the impairment, so you need to understand few things, which is that the subsidiary should be treated. The subsidiary should be treated as a cash generating unit. The subsidiary should be treated as a cash generating unit. The recoverable amount of the subsidiary should be compared with its carrying amount, including goodwill, for the purposes of impairment. The recoverable amount of the subsidiary should be compared with its carrying amount, including goodwill, for the purposes of impairment. Now, the impairment loss should be allocated to the obviously impaired asset first, and then to the goodwill, and the remaining amount should be allocated to the remaining assets on a pro rata basis. In order to establish the impairment loss, goodwill of the 100% business is to be considered. So there is some sort of a write-up that I am doing with respect to it. These are some discussion that I'm doing, which is basically the number one point is that the whole subsidiary has to be treated as a cash generating unit. I repeat, the whole subsidiary has to be treated as a cash generating unit. The second thing is that the recoverable amount should be compared with the carrying amount, including goodwill, for the purposes of impairment. And the third thing is that the impairment loss should be allocated. The impairment loss should be allocated in order to establish the impairment loss in such a way that if there is an obviously impaired asset, you allocate to that asset first. And later on, what you could do is that you could allocate to the remaining assets on a pro rata basis. You can allocate to the remaining assets on a pro rata basis. Now, how would we do it? So basically, when there is this, assume when NCI is measured at fair value, the goodwill is full goodwill, that is for the 100% business. The carrying amount of net assets is what? What is the carrying amount of the net assets? The carrying amount of the net assets is 106 million. I repeat, the carrying amount of the net assets is 106 million. The goodwill of the business is what is 24 million. Hence, the carrying amount of subsidiary is this plus this. Then the recoverable amount is going to be what? You got to see the recoverable amount. I repeat, you got to see the recoverable amount. What is the recoverable amount of the subsidiary? The recoverable amount of the subsidiary was estimated to be 100 million. I repeat, the recoverable amount was estimated to be 100 million. So that means there is actually an impairment loss of 30 million. How would we allocate this impairment loss? This impairment loss would be allocated to what? To the land and the buildings of 4 million. Then to the goodwill, which is gonna be 24 million. So the balance impairment loss is what? This minus this 2 million. And when the balance impairment loss is going to be 2 million, it has to be allocated to the remaining assets, other plant and machinery, other intangibles. It would not be allocated to current assets because they are already at the recoverable amount. Other plant and machinery, other intangibles. So that is actually going to be what? 2 million multiply by 2 million multiply by what? Multiply by 15 plus 9. 15 divided by 15 plus 9. So hence, resultingly, this is how it is all going to be allocated. I repeat, this is how it is all going to be allocated. Do you people get it? Kindly confirm to me, then I'm going to move on to the next area. Yeah, please confirm to me, then I'm going to move on to the next area. Okay. Now there are people. How you got the goodwill? It's already calculated. We calculated this goodwill. Okay, we calculated the goodwill here. See, we calculated the goodwill here, Mustafa. Then, okay, why land and building $4 million? Okay, kindly read the question properly, please. The question tells you that there is a specific impairment for this asset of $4 million. So if there is a specifically identified asset, so you got to tell us. Yeah, apologies, my internet got a bit disconnected. Please confirm that you all are okay with this calculation, please. Kindly confirm so that I can move forward. Okay, good enough. Thank you very much. Now, in case if you have got a partial goodwill, I repeat, in case if you have got a partial goodwill, well, the screen is in front of you, Ademola. Are you not able to see my screen? Okay, in case if it's a partial goodwill, there are things that you need to understand. This would remain the same. Here, you need to gross up the goodwill. You need to gross up the goodwill. How would you gross up the goodwill? You would say equal to this goodwill divided by 80%. Why am I dividing this goodwill by 80%? Because this represents 80% goodwill. This is not 100% goodwill. So resultingly, this is what the impairment loss is going to be. Again, the impairment loss is going to be allocated. I repeat, the impairment loss is going to be allocated like this. The impairment loss is going to be allocated like this. How would you allocate the impairment loss? Try to understand this. You would say 4 million is going to be allocated to this. Then 24.5 is going to be allocated to this. There's going to be this balance. And hence against this way. Okay, I'll clarify on the partial goodwill. You see. Okay, now Ademola, I thought the allocation should start. Okay, now you see what happens is a lot of students, they miss this specific area of IS 36. IS 36 says that in case if there is a specific asset which is apparently impaired, so you should write down the impairment loss on that asset first. Then you move on to the next areas. Okay, let me clarify for the partial goodwill. Although we calculated the goodwill to be 19.6 here, but this is for the 80% business. You got to gross it up. I repeat, you got to gross it up. Is this okay? Okay, why gross up? Because this is a 80% goodwill. You cannot compare the 80% goodwill with the 100% recoverable amount. The recoverable amount is for the whole subsidiary. I repeat, recoverable amount is for the whole subsidiary. So if case, you need to include the 100% business's value. Okay, so calculation of, what was it? Discuss the calculation. We discussed it. Allocation of impairment loss and why impairment loss would differ on how NCI are measured. We have understood this. Your answer should include a calculation and an explanation of how impairments would impact the consolidated financials of Luploid company. Now, this is also something that you need to understand. So, you're going to be talking about this subsidiary should be treated as a CGU, recoverable amount, etc., etc. And furthermore, the impairment loss under fair value method will be recognized in full in PNL, that is 30 million. Whereas when NCI is measured using proportion of net assets method, the impairment loss, although allocated to the goodwill, is 24.5, but the amount to be recognized in the PNL will be 80%, as 80% of the goodwill is recorded in the books. So out of the total 30.5 million impairment loss for partial goodwill method, amount to be recognized in PNL shall be 4 million plus 24.5 into 80% plus 1.25 plus 0.75. This is what it is going to be. Okay, is the balance in the partial goodwill wrong balance? Okay, now this minus this minus this. It's a correct balance. How could it be 1.5? Kindly, can you please guide me? How could it be 1.5? Yeah, can somebody please let me know if I have done the calculations correctly or not with respect to it? Okay, have we done some error? Have we done some mistake? Equals to this goodwill divided by 80%. There is no error. The calculation is correct, please. This whole calculation is correct. Okay, pro rata is also correct because I think the remaining impairment loss is 2 million. I mean, you see what happens is the difference here is that 25.6 million will go to PNL, whereas in this case, in the case of full goodwill, the entire 30 million would go to PNL. Okay, is it okay now? Uh, yeah, Nadesan, you are right. Edwin, how do you do partial? Okay, now see, there is a logic. I'm not getting into that how the partial goodwill could be higher. At times, the NCI is undervalued. At times, NCI is undervalued, so the full goodwill can be lower than the partial goodwill. Yeah, we only take 80% of the impairment loss of the goodwill to the P&L. So I hope every one of you is okay with it, please. Yeah, every one of you is okay with it, right? Okay, good enough. Now see, there is this last part of the question, which actually is how the consideration for the acquisition of Hammond Company should be measured on 1st July 2007. Your answer should include a calculation of consideration and a discussion of why only some of the cost of replacement share scheme should be included within consideration. That's one thing. How much of an expense for the share-based payment scheme should be recognized in consolidated P&L of Luploid for yeah, let me know when you have done it, please. Let me know when you people have read this part. Okay, now let's just start. It says Luploid Company acquired 60% of the 10 million equity shares on 1st July 2007. Two Luploid Company shares are to be issued for every 5 shares. Then it says these shares will be issued on 1st July 2008. The fair value of a Luploid share was $30 at 1st July 7. The fair value of the Luploid share was $30 at 1st July 7. Hammond had previously granted a share-based payment to its employee with a 3-year vesting period. At 1st July, the employees have completed their service period but had not yet exercised their options. The fair value of the options granted at 1st July was $15 million. As part of the acquisition, Luploid is obliged to replace share-based payment scheme of Hammond Company with a scheme of its own, which has the following details. So it's actually a mixture of IFRS 3 and the IFRS 2. That is something that we have to consider. Now, Luploid issued 100 options to each of the Hammond companies, 10,000 employees on 1st July 7. The shares are conditional on the employees completing a further 2 years of service. Additionally, the scheme required that market price of Luploid shares had to be increased by 10% from its value of 30 at the acquisition date, from its value of 30 at the acquisition date over the vesting period. It's anticipated that 1st July 7, 10% of the staff would leave over the vesting period, but this was revised to 4% on 30th June 8. Fair value of each option at the grant date was 20. The share price of Luploid was 32 at 30th June 8 and is anticipated to grow at this rate. Now, it's one of those areas which is actually a complicated areas, and we need to do the proper accounting for it. We need to understand this question now. So how exactly are we gonna be going through this specific question? For this, what you need to do is that you need to try and understand few of the requirements of IFRS 2 share-based payment transaction. I will be using a bit of this pen rather than explaining this whole onto the Excel. See, when it comes to this IFRS 2 share-based payment transaction, you have got equity settled share-based payment transaction. And the expense is recorded at fair value on grant date multiply by number of options expected to vest, and the expense is recognized over vesting period. Now, there are multiple things that you need to acquire. You acquired the subsidiary on what date? You acquired 10 million equity shares, 60% of 10 million. So that means you acquired 60% of 10 million shares, gives you 6 million shares. To each of Hammond's company, 10,000 employees, sorry. 60% of the 10 million equity shares of Hammond on 1st July 7. So what is the date of acquisition? It's 1st July 2007. Now, 2 Luploid shares are to be issued for every 5 shares acquired in Hammond. Number of shares to be issued are going to be 2 upon 5 into 6 million. That means 2.4 million shares are going to be issued of Luploid. Now what next is there? These shares will be issued. Okay, even if you are going to be deferring the issue of the shares, that doesn't actually matter. That doesn't actually matter. The thing is, you have committed. The fair value of Luploid share was 38 1st July 7. We are not going to consider what is going to be the value 2 years later. We're going to consider the value which is right now. So 2.4 into 30. So the shares that you are going to be giving, it's going to be worth 72 million. Then it says the fair value of the option, sorry, at 1st July 7, the employees, no, there is another thing. Hammond Company had previously granted a share-based payment scheme to its employee with a 3-year vesting period. At 1st July 7, employees had completed their service period but had not exercised the option. Fair value of options was 15. As part of acquisition, Luploid is to replace share-based payment scheme with a scheme of its own, which has the following detail. So now, the replacement awards are also required to be considered. How much of the replacement award is going to be considered, you need to understand. The original vesting period was 3 years. The revised vesting period is 5 years. So already expired period is 2 years. Now, what you're going to do is that you're going to say 15 million is the fair value of these awards. So 15 million multiply by 3 upon 5 is what has been earned. So 9 million, this is going to be considered in the cost of investment. This 9 million is going to be considered in the cost of investment. So basically the cost of investment would be 72 plus 9, 81 million. I repeat, kindly look at it up till now and then I'm going to move forward. Because you see, you are acquiring the subsidiary and you're giving two types of consideration. One, you're giving your own shares. That is okay for everyone. But you are replacing the already awarded shares. There was a share-based payment scheme. You are replacing that. You are giving them a new award. From the new award, that is worth 15 million. 3 upon 5 has already been vested. So that is a consideration that is being given for the acquisition. Yeah, expired is 3 years. That's why it's included in the cost of investment. Sorry, already expired is 3 years. This is the original vesting period. This is the revised vesting. Kindly look at it, please. Yeah, are you people okay now? Now, you see what happens is the 15 million is the value of this original scheme. Now, I think everyone is okay till this part, 72 million. Everybody is okay till now. Now, let's move forward. So the next thing is that what are we doing with respect to the replacement award? You see, the employees had already been offered the share option scheme. We are canceling that scheme. We are replacing that with another scheme. The original scheme was already vested, but now we have cancelled it and we have actually replaced it with a scheme of 5 years. They have served us for 3 years. So if they have served us for 3 years, they have a right to earn 3 years. If they have served us for 3 years, their right is to earn for 3 years. You get it now? Okay, now. So basically, when you talk about the consideration, this is how the consideration is going to be calculated. Now let's move a bit forward and discuss further. The next aspect is it says that how much of the expense is going to be recognized in the consolidated profit or loss. Okay, now let's try to understand. Additionally, scheme required that market price of Luploid shares had to increase by 10% from its value of 30 at the acquisition date and so and so, so and so. It's anticipated at 1st July that 10% of staff would leave over the vesting period, but this was revised to 4%. Fair value of each option at the grant date was 20. The share price of Luploid at 30th June was 32 and is anticipated to grow at a similar rate in the year ended so and so, so and so. Now, try to understand this thing. Basically, what happens is at 30th June 2008, you would say we have 10,000 employees, of which 4% are expected to leave. Four percent are expected to leave, so that 96% would remain. There are 100 employees, and the value of the share is 20. So this turns out to be how much? 10,000 into 96% into 100 into 20, 19.2 million. Less already expensed is 9 million. Why already expensed? Because this is included in the consideration. So 10.2 is the remaining amount. So the expense for the year is going to be 10.2 multiplied by 1/2. Why? Because after the acquisition, there is going to be 2-year period remaining. So resultingly 5.1 million is the expense that you got to recognize. I repeat, 5.1 million is the expense that you got to recognize at 30th June 2008. This is the application of IFRS 2 because you are going to recognize the expense based on the amount expected to vest. 10,000 is the option. Multiplier 96% is the expected vesting. 100 was the total employee. Multiplied by 20 was the market value at the grant date. At the grant date, which was the grant date? At the replacement date. Kindly confirm if you all are okay with this. Okay, why multiply 2, 1/2? Because you see, when you acquired this company, already 3 year has passed. You revised the scheme, made it 5 years, so 3 year have passed. The remaining time period is 2 year. So you got to spread over the remaining vesting period. Yeah, kindly confirm if all of you are okay, please. Okay, good enough. Okay. So we are actually done with this question, the name of which is Luploid company, and it was a 30-mark question featuring consolidation and the connected areas. And it was like somewhere the other consolidation was in it, whether that be the application of IFRS 13 was there, but consolidation was there. Whether that be the application of this IFRS 2, the consolidation was also there. So this is how things are going to be. 32 is actually the movement after the acquisition, and that needs to be ignored because you got to consider the price which is applicable at the date of acquisition or the date when the replacement award is granted. So, yeah, in the case of equity settled narration, in case of cash settled, you got to use the reporting date fair value. Okay, good enough. So we are done with it. And we are going to end our class today here. And we are going to discuss further in our next class.